Holy smokes everyone, I've got a banger of a video for you today. In this video, we're going to be going over how the Federal Reserve is trapped, they've completely stuffed up, there's nothing they can do now to prevent the crisis. Either we're going to go down the high inflation route and they won't be able to stop that, they'll have to lift interest rates and the markets are going to have to come down, or they're going to have to act now and all eyes are going to be on the Federal Reserve minutes that are released today, and if they do start to even mention or tapering, we're going to see the stock market declines accelerate. But in this video, I'm going to break down exactly why the Federal Reserve is stuck, why they're cornered, why they're trapped, and there's nothing they can do. And I'm also going to show you a few more facts and key information about why the stock market just doesn't only go up and why we could be entering into what's called a lost decade. Because everyone, what you have to know is the biggest indicator backed by science, backed by facts. This one thing proves the stock market is going down today. I just got a haircut, and that is the number one indicator that the stock market's going down. Okay, let's not waste any more time. Let's get right into it. All right, everyone, looky here. First things first, something that we already know is inflation is here. The CPI had its fastest increase since 2008, and this is double the Federal Reserve's mandate. And this is the official CPI number. We all know real inflation is much higher than that. And looky here, the US producer prices surged 6.2% in April, the highest since 2010. And when you look at core inflation, that excludes energy and food, this was the highest number since 1981. That's right, inflation of the 80s could be coming, and it could be coming quick. Energy prices overall jumped 25% from a year earlier, including a 49.6% increase for gasoline and 37% for fuel. But I've already covered a lot of that. But look at commodities. Commodities are in hyperinflation right now, and we need commodities to make things. So if commodities are going to skyrocket, so is the cost of everything else going to skyrocket. And look at this, ethanol up 63%, gasoline 51% year to date, metals, platinum is up 13.9%, agriculture, canola is up 48%, lumber 44% year to date, corn 34%, palm oil 21%, milk's up 19%, and coffee, people are going to be freaking about coffee, it's up 18%. And look at this, lean hogs up 56%, and poultry is up 20%, and beef is up 8.9%. So the sad reality, if the Federal Reserve doesn't act now, there's going to be people that won't be able to have a good 3 healthy meals a day. And look at the industrial metals, lithium up 91%, rhodium 65%, tin 49%, iron ore is up 36%, cobalt up 35%. We're in pretty much hyperinflation right now with commodities, but people don't know it yet. But I've already talked about inflation, but I'm going to be talking more specifically about how the Federal Reserve is trapped and what's this going to mean for the stock market, the cryptocurrency markets, and the housing market. Okay, so I'm going to show you some key, very important information that you have to consider and take into account, because if we don't learn from history, we're bound to repeat it. Everyone, this chart right here explains why we've been in a 40-year bull run, and while it seems like the stock market only goes up, right, and no matter what, no matter how much crashes we get, it always comes back to its all-time highs. Well, you know why that's been the case over the past 40 years? Because look at this. Interest rates in the 80s went up to 19%. Imagine if interest rates just went up to 5%, how catastrophic that would be for the stock market and housing market. We'd see a complete 40 to 50% drop straight away. Now, what they've been able to do to respond to every recession is drop interest rates lower and lower. So we can see here they dropped from 19% to 8%. That was a full 10% drop. Then the next crisis, it dropped from 11% to 6%. Then they dropped it from nearly 10% from 1989 all the way down to 3%. And again, in the 2000 stock market bubble, they dropped it from 6% to 1%. Then in 2008, they were able to drop interest rates by 5%. And in this crisis, they could only drop it by around 2%. Now, what this means is if we do get a double dip recession or another stock market crash, the Federal Reserve isn't going to be able to drop interest rates like it used to do in the past to prevent the crash from getting worse. Also, this is another huge reason why the stock market has been going up, is because the M2 money supply has gone completely parabolic and they're barely even recording it anymore. They said they're going to change the data to monthly. We have only got data from March. Where's the April data? It seems like something very suspicious is going on here. And another very powerful chart that shows you why the stock market has been going up. But if this trend is reversed, the stock market definitely is coming down. And this is because of the Federal Reserve's balance sheet. As we can see here, in 2008, it went straight up and they've been slowly creeping up ever since they couldn't turn the money printer off ever again. Once they turned it on, they tried to taper it in 2018, but that's when we had the repo market crisis and the stock market crashed 20% straight away. So they actually started QE in September of 2019, and then in March 2020, it pretty much went parabolic and they've been increasing their balance sheet ever since. But let me show you something very interesting. As we can see here, this is the S&P 500 and the central bank and the Federal Reserve's balance sheet. The red line is the S&P 500 and the blue line is the Fed, ECB and BOJ's balance sheet in dollars. And as you can see, when that goes up and when that goes down, the S&P 500 goes up and down. But let's have a closer look to show you more proof that this is correlated. For example, on June 9th, the Federal Reserve started to taper its balance sheet a bit last year. So let's have a look at the S&P 500. And look what happened on June 9th. It peaked at 3,200, the S&P 500, and then it started to drop straight away right as the Federal Reserve started to taper at the same time. And the S&P 500 only got back to its all-time high of 3,200 on July 15th. And as we can see here with the Federal Reserve's balance sheet, that is also when the Federal Reserve started to increase its balance sheet again. People, are you starting to see the correlation here? And this is why the stock market is selling off right now, because the stock market is starting to price in that the Federal Reserve is going to have to start tapering because of the crazy amounts of inflation. And the markets are always forward looking and they always try to predict what happens in the future. So the markets are saying, look, we think the Federal Reserve is going to have to taper. So they're starting to sell off now in anticipation. But it all comes down to what the Federal Reserve minutes are going to say today when it is released, and to see if there's any changes in tune in the Federal Reserve's language. And again, with how the markets are forward looking, the market's always looking what's going to be the next catalyst to either lift the market or bring the market down. And valuations in the S&P 500 have got crazy. And as we can see here, the S&P 500 PE ratio is 43. Now, historic average is normally 17 to 20, but the stock market and all the market analysts says, look, as long as interest rates stay low and the Federal Reserve continues its QE, these high valuations are justified. But if the Federal Reserve starts tapering and is forced to start lifting interest rates because of inflation, these high valuations aren't justified anymore. And again, with the markets always being forward looking, we'll look at the S&P 500 dividend yield now. It is 1.4%, but the 10-year US Treasury is 1.66%. So now the 10-year Treasury yield is higher than the S&P 500 dividend yield. So there is an alternative now. And if the 10-year Treasury keeps going higher, we're going to see more and more of a rotation out of stocks and back into bonds to wait for a correction. And also, before there was huge amounts of stimulus, they sent about 3 or 4 different amount of stimulus checks, but there's no more stimulus checks coming in the mail now to lift company earnings, because we had crazy earnings in the stock market. And so that was another reason to justify these crazy price to earning stocks, was because they expected earnings to rise. But now that that stimulus is being taken away, company earnings are going to fall. And also many states are looking at ending unemployment much earlier than September, and they're looking at ending it right now. So that means incomes are going to fall and company earnings are going to fall. And in the Great Depression, there was an analogy. There was a stockbroker and he was getting his shoes shined by the shoe shine boy. And then the shoe shine boy started talking to him about the stock market and about how he can make so much money in the stock market. And that's when the stockbroker realized that now is the time to get out of the market, because every man and his dog and even the shoe shine boy is talking about stocks. And this analogy happened to me today as well. Again, going back to the haircut indicator, I was getting my hair cut by the barber, and then all of a sudden he started asking me about stocks, and he started asking me about crypto. And I asked him, do you normally invest, or do you know much about investing or about cryptocurrency? And he says, no, I don't know anything, but I heard my friends are making heaps of money, and I heard people putting $1,000 in these cryptocurrencies and stocks and becoming millionaires in a few months. And that clicked in my head. I said, what's happening today is exactly what happened in the Great Depression in 1929, when people became millionaires in a year or 2 years and then lost everything. And the exact same thing happened in the dot-com bubble. People, history doesn't always repeat, but like I said, it often rhymes. But right now, it's rhyming and it's rhyming like never before. And you want to know something that's really crazy is stocks don't only go up. People think, oh, you know, if you just invest in it, even if it crashes, it'll go up next year or the year after or in 10 years. But look what happened during the Great Depression. In 1929, the S&P 500 hit about $595. And you know what? It didn't recover for 27 years until 1956, 27 years later. Imagine what would happen to people's psychology if the stock market crashed and it didn't recover for 27 years. But you know what? It gets even crazier. Even after it recovered, it crashed again to the 1929 levels, again in 1985. So imagine if you bought stocks in 1929 and you held it all the way till 1985 and the stock market didn't move at all for 57 years. And when you factor in inflation, you would actually lost about 50 to 70% of your purchasing power. So just because stocks have only gone up for the past 40 years, it doesn't necessarily mean that's going to continue for the next 20 or 30 years. Now, I'm not saying this is going to happen, but it is definitely a possibility. And obviously, the markets don't believe inflation is going to be temporary. We're having a complete global stock market sell-off right now. Where I live in Australia, the ASX 200 was down 1.9%, the worst performing stock market or major stock market in the world. The Nikkei 225 is down 1.28%. The New Zealand stock exchange, the DJ, is down 1.6%. The DAX, the Germany stock market, is down 1.3%. The S&P 500 is down 0.8%. The FTSE 100 is down 1%. We can see we're in a complete global stock market sell-off right now. All I see is red. But what you have to know is it's not going to take interest rates to go back to their levels in 1981 or 82 of 18 or 9%. All it would take would be for interest rates to go up just 2 or 3%. If interest rates go up 2 to 3% to combat inflation, the stock market's going to fall at least 20 to 30%, and it could possibly fall 40 to 50%, and the housing market will fall 20 to 30% and maybe more, depending on people's psychology and if all these big hedge funds that have been buying properties start selling them off. Because even if your mortgage is fixed for 30 years, if a bunch of other people in your street sell their property and they sell it for a loss, well then when you get your property appraised and the appraiser looks at all the comparable sales in your street and they're much lower than yours, well, your property value is going to fall as well. And the scariest thing is the Fed may not be able to stop inflation because a lot of this price increases is coming from supply chain disruptions. And if these supply chain disruptions don't get fixed, well, the Federal Reserve, even if they lift interest rates, won't be able to get inflation back under control. Now, the only way I see the Federal Reserve preventing a stock market crash and a housing market correction is if they completely ignore inflation and let it run hot. But that will come at the cost of the middle class and the poor. They'll sacrifice the middle class and the poor to bail out their friends at Wall Street. And people, we can't let that happen because that will make the cost of living completely unbearable. And like I said, the only way they can prevent this is if they do something called yield curve control, where the Federal Reserve lets inflation run hot, they start buying treasuries to lower the yield on treasuries, and they monetize the debt, and they let the US government take on as much debt as they can. The US government issues those bonds. Nobody wants to buy them because they know that the US government is insolvent. So the Federal Reserve buys all the treasuries and they monetize the debt, and then the government creates UBI and gives this universal basic income to people just so they can afford the basic essentials. And also what I would imagine what would happen in a complete market meltdown is they would hail in the central bank digital currencies, and they'll create again just more fake fiat money, send it to your digital wallets to go out there and spend and buy just the basics. But people, I think that is highly unlikely. I think the more likely scenario is the Federal Reserve is going to have to taper. They're going to have to slightly lift interest rates. We're going to see a correction in the stock market and the housing market, and things are going to have to cool off and finally get back to a normal average level. So everyone, what do you think about this? Let me know down below. Now, for all my loyal viewers and subscribers still watching, you're awesome. I hope this video was informative for you, and if you haven't already, please tap that like and subscribe button. I'll keep you all up to date on the latest that's happening in the stock market, the housing market, and global finance news. If you're bored, I'll put up some other videos here. I'll see you there.